Hello and welcome, everyone. I am Sarah Snell Cooke, your host here at the Credit Union Connection. I am joined today by Michael and Michael. Now, I've been told I can call them Michael Berman and Michael Carpenter. Welcome.
Thanks for having us.
And they're from a company called Ncontracts. Michael Berman is the CEO there. Why don't you tell us a little bit more about yourself and the company?
Fantastic. First, Sarah, thank you so much for having us on. My name is Michael Berman. I'm the founder and CEO here at Ncontracts. I'm a recovering lawyer turned entrepreneur. So I've been involved in third-party risk management and operational risk management, both as a lawyer as well now for 17 years, helping financial institutions and wealth management firms and mortgage companies deal with the complexities of operational risk management, including third-party risk management.
Yep, always a big topic of discussion. And Carp, tell us a little bit more about yourself.
Yeah, thanks, Sarah. And I echo Mr. Berman. Glad to be here. Out of the military, my early time in the financial institution space was really financial intelligence, a BSA AML focus. But then when I went to community banks and then ultimately credit union, I served as a risk officer, chief risk officer, and really owner of the vendor management programs. I used in contracts as a client, and so now I'm here and get a chance to talk about my experiences.
Yeah, that's perfect as a credit union person, being able to talk from that side of the fence as well. So the reason I asked you all here today, because I understand you're launching a book, The Upside of Third-Party Management. Make it sound so positive. The third-party risk management, the practitioner's guide to turning vendor risk into strategic value. Now, what is the impetus behind this book?
I'll go ahead and start. Yeah,
Yeah,
I'll
go ahead.
I'll start. So colleagues of ours and internally in contracts, we look at vendor management. The floor of third-party risk management is established through some pretty standard and well-known doctrine. And it talks about the five stages of a vendor management, and it has focus on risk, and as it should. However, as you mature, then you start to actually gain a lot of benefit from the effective risk management that you do. Examples include an awareness of not just that the vendor is important, but the actual impact to the organization should it go down, giving you much more insight to make informed business decisions. Does the contract have liability amounts that actually address the impact of an outage? Does our insurance, is it appropriate? Do we have appropriate backups? Does the vendor actually help me get where I'm going? So that's a lot to say, but there is a broad spectrum. And from 2015, when we really started as a financial industry, getting serious about vendor management, having programs, there's been a shift. And now the ship is turning to being strategic and doing things for business purpose.
And
Yeah.
to add to that, I think there's a lot of fear mongering out there where people think third-party risk management is somehow equivalent with cybersecurity, and I need to just do this for defensive purposes. And I like the analogy of third parties are a lot like the people your credit union works with. So you have employees and you have vendors. Can you imagine running a credit union and never meeting with any employee to do a review or never really managing your employees in any way whatsoever? And yet we have vendors that once they're onboarded, nobody really manages. And yet they have access, some of them, to every piece of member information. And so when a credit union does an effective job at managing those third parties, they can get much better outcomes for their members. And it becomes a benefit to all those members. Is the vendor providing all the things I want? How's the vendor evolving as I evolve as a credit union matters so much more. And there's a lot more to it than just, did the vendor do something bad? We want the vendor to do great things for our members as they move forward, just like we want our employees to do great things for our members as we continue the mission.
Yeah, that's really interesting insight there. And I'm going to ask you, I'll stick with Berman for a while. The premise of the book is the programs aren't failing because controls are missing. They're failing because it's not connected to the executive strategy, which
Mhm.
you guys have both touched on. Can you explain a little bit more about that, please?
Absolutely. So when it comes to thinking through what is our long-term mission, what are we trying to accomplish, what are our goals as a credit union? There are multiple ways to get there. And part of that is the vendor relationships, because most credit unions are never going to develop their own technology for online bill pay, digital wallets, now cryptocurrency, the list goes on and on. And so you've got to partner with the right vendors. But that's more than just the vendor's not going to lose my member data. We certainly hope that doesn't happen. And I want to make sure the vendor's financially solvent. And you can tell I'm checking boxes, right?
Mhm.
Okay, they do those things, but what is really being delivered? Where's my vendor going? And one of the things that's fascinating is vendors are evolving. When we buy a subscription to software that's all online, and most software is now online, it's not static. We're not buying a rug that's going to be in the center of the lobby of the credit union, and then we're done decorating and we're done. Instead, this thing's going to constantly evolve. Is it going to evolve in a way that helps my members over time? Or is it going to create burdens for us that we didn't realize? Because every time we change our own internal employee work structure, we've got to spend resources changing a workflow in some software that no longer fits our organization. And we just created unintentional costs that no one's really accounting for. And that ultimately harms the membership. And some extreme examples, but ultimately we're trying to get those things aligned so everything's working in lockstep towards the goals that the executive team for the credit union lays out for their organization.
Anything to follow up, Carp?
Yeah, I would say if you don't define or know where you're going, then how do you know when you get there? Or how do you know when you're going the wrong direction? And yeah, I agree with, of course, everything Mr. Berman said.
And so financial institutions, as we've seen, especially as tech has evolved, they aren't running themselves anymore. We're using all these vendors to come in and run the credit union, really. And so from an operational perspective, at least. And so when when one of these vendors fail, and it happens, we know some stories, but I want to, what are some examples that you can provide that might cause the biggest issues for credit unions that are somewhat common mistakes?
I can start if that's okay. I think I'll start with the one that I think people don't pay nearly enough attention to, which is business continuity management. So people will have outages. And if you aren't paying attention, as you mentioned, I still think the credit union leadership runs the credit union, but you're dependent highly on these systems to provide access to members' money. And that relationship more and more is digitally oriented, where you're using an app or you're using a web interface to interact with the credit union. And if it's down, the whole credit union is basically down. And so if you don't fully understand the business continuity, meaning if my vendor's down, how long can they be down for? What are their backup systems? Are they tested? This is no longer a check the box exercise. This is now I'm down. And how long can I be down before my members have real problems because they can't access their money? They can't live their lives the way they're used to living them because of this outage. And they're not going to blame the vendor. They're going to blame the credit union. And we've seen this happen time and time again now, where a credit union feels blindsided because all of a sudden they have a disruption in service caused by a vendor who didn't have an adequate business continuity plan, and no one had done the adequate planning to think about what do we do if this happens. And that's a just classic case of how this manifests itself in the real world and creates real problems.
And I've heard experiences where a credit union can't get the testing results of that business continuity plan. They don't get the access to the results of the testing of the plan, which I think is kind of
And
interesting, something that they should really insist upon. And
There are ways
Carp,
around
oh, go.
there are ways around that. It pains me to hear that because that's a big vendor bullying a credit union. Time to make sure you've got that, and this always, I hear Michael Carpenter talk about this all the time. It's failure to plan. And then an E means you set yourself up for this. That should be in the contract. That should be a required boilerplate. And no, this is not an advertisement for pay lawyers more money. You should have a set of things you're requiring that are basic for anything that's a critical service for you. And if the vendor won't agree to those things, which includes giving you their business continuity plans and their test results, you need a new vendor. As painful as that might be, you need somebody who's going to provide that for you, because what you're basically saying is this vendor relationship is more important than my members' experience. And I can't imagine any executive at a credit union who says, yep, that's the value I have. And it's a short-term lack of pain, switching a vendor, to long-term pain when that vendor does something bad and I now have zero recourse, nothing I can do, and my members are the ones who suffer. And so that planning is just absolutely critical to having successful vendor relationships.
Absolutely. And Carp, I want you to follow up on that, but also having been inside a credit union working as the CRO, the Chief Risk Officer, credit unions have historically prided themselves on the human touch, on knowing their members, local community, that sort of thing. And so how should credit unions also look at this from a competitive position and how it affects member relationships as more and more vendors are coming in?
I love that question. Third-party risk management, it actually is every single individual. I'm glad you really touched on that credit unions differ in the fact that they have these relationships with their communities, right? They're member owned, they're member driven. And so every single employee at a credit union is like the liaison of the vendor almost. They are the face of the products and services offered by that third party, right? So when the third party isn't performing well, the face then is the one taking the blame. And then customer attrition, or member attrition, I should say, that could be a real problem, because the economies of scale can benefit membership. And as members leave to go somewhere else because what looks like the business isn't working, the vendors aren't working, right? There's actually citable data that shows just how much it costs. Attrition costs a credit union, which ultimately affects the membership, affects the ability for the credit union to offer like more competitive rates, like in the auto lending and home lending and all of these things. It's this trickle down effect. So to answer your question, competitively, and market competitiveness does matter. You don't want your members leaving. More members can benefit the collective. And efficiency ratios may look decent on paper, but not doing our best to get the most out of what we invest in our third parties ultimately affects the membership. Again, all of this to say, members leaving cost the in one way or another.
Absolutely. And we've seen that play out in headlines along the way over the years, I'm sure. And particularly Michael Berman, what should credit unions be thinking about with their vendor concentration risk these days? I feel like I hear there is a trend back toward one vendor that can serve multiple purposes versus a bunch of different small vendors like the fintechs that are coming in.
Again, there can be advantages to having one vendor. And of course, those vendors are typically Jack Henry, a Fiserv, an FIS, and they do have a tremendous number of solutions. Now, whether you're getting best of breed solutions for everything you just signed up for is another question. And what it does, it simplifies some things and it complicates others. So things, obviously, it simplifies. You've got probably better interfaces between the solutions. You've got one vendor, which means you've got one set of financials to review, one set of, that's really the only one that gets unified, because you're still going to want to do tests for all the procs and all the SOC reports you still need to do for that vendor, but you feel like you've simplified things. On the other hand, you've complicated another matter that many people bury, which is, if I ever have to switch, I've got to switch it all. And so what does my business continuity plan look like at my credit union if I have to get off 30 products at my core? That's going to be pretty complicated to put together. And probably our friends at the big cores aren't going to help you with that, because they never want you to leave. They believe in the Hotel California method of once you're on, they really want to make sure you're never, ever going to leave. And that's okay. But technology changes, companies change, leadership changes. And probably the most egregious contract I've seen without naming the core vendor is a 25-year agreement for a core system. So let's think about that. Did the phone change at all in the last 25 years? Did computers change at all in the last 25 years? Tech is moving super fast. That is a lifetime in technology world. And while it might sound good and you get great pricing, you are creating other costs that are real that will impact the credit union. And so it's got to be part, going back to the strategic plan. What are we trying to accomplish and how do we get there? And typically it's not with a long-term 25-year agreement with one vendor because you're creating a tremendous amount of risk. It'd be, going back to my analogy, it's the same as saying, I'm going to hire one person to work at the credit union and they're going to do everything. And let's just hope they don't get hit by a bus.
Yeah.
Can I add to that, Sarah? I think about being at, a credit union, we wanted our members to use every product that we had available for that member, right? And the credit union has a narrative of why that benefits the individual, right? There's pros and cons to everything. But for the credit union, when it talks about it to its member, about you don't need to go to financial institution A for that product and financial institution B for that other product, and then us for this product, they want them all here. And most of that from a credit union perspective is a relationship angle, right? You can trust us and us, right? It's the one place. Consumer isn't worried about the credit union going down and all their eggs being in the one basket, right? So again, a pro is a relationship. But like all the things that Michael mentioned, cons could be in almost the lack of information. And then ultimately, once like Michael said too, strategic. So if we're focusing on where we're going, one vendor helping us in lots of different ways to get there and actually doing it, great. One vendor tied to many areas, not helping us. So great.
Absolutely. Absolutely. So we're running close on time. I want to make sure I got to mention AI. You can't do this talk vendor management risk without talking about AI. And I know this is also in your book as well. What are some of the key topics under that AI vendor risk management that are new, perhaps? Michael Berman.
Yes.
Either of us can start. I think people need to understand the first thing is what is AI? Because there's a lot of noise in the marketplace, and what one vendor calls AI, it's not necessarily a textbook definition of what AI really is. And then there's the due diligence. So you need to be asking your current vendors, even if you're a credit union that's not looking to get into AI, that's okay. But your current vendors may already be leveraging it. And what risk does that create? Speaking about how vendors change over time for your credit union, that you now have to make sure you've got the appropriate controls in place. And whether you're talking about Fannie and Freddie, who have rules if you're selling mortgages to them around AI that you've got to comply with, the list goes on. I'll run out of time talking about it, but you got to have a framework to evaluate vendors, both current and prospective, from an AI perspective, from an AI point of view. Michael?
I'll say two major points. One, consistency. Number two is risk-based. And then the risk-based, that is thrown around a lot, but AI by itself, applying Michael's statement of true AI, define it for yourself so you know what you're looking for. It isn't scary just by its presence. It can be more risky dependent on its impact should it go away, its impact should it get it wrong. Again, back to consistency. Set what is risky to you, set what is more risky than another, and then be consistent in your response. The fastest way I can take AI vendor management.
Excellent. Excellent insights. Thank you. Now, I always allow my guests to have the final thoughts. We'll start with you, Michael Berman.
I appreciate certainly the time here. Great Union Connection. I certainly would encourage people to read our book on the upside of third-party risk management. And if you have any questions, please let us know. We'd be delighted to help in any way that we can.
Awesome. Thank you. And Carpenter?
Yeah, I would say that you can get by meeting the expectations of an examiner, but I believe in the industry and the professionals that I've met and not just doing the minimum. The book attempts to make things reality and operational. So yeah, read the book.
Excellent. Awesome. Thank you guys for your time. Appreciate it.
Thank you.
Have a great rest of your day.
Do the same. Thank you.